Hey everyone, it's Imran from Options Insight, your macro options spotlight for today. All right, so markets held in pretty well on Friday into expiry. We had said that 4,000 level was quite a big one. So it seemed to be keeping the markets really not quite pinned to 4,000, but not really letting them stray too far away, let's say. So that's kind of what we experienced on Friday. Over the weekend, though, markets have kind of weakened a bit. We've got China COVID concerns seem to be getting worse, with their cases going, to the highs. Commodities have generally been softer on the back of that story, but also the dollar starting to regain its footing a bit, as Bullard comments were pretty hawkish. And we saw copper down nearly 2 standard deviations on the week, around 7%. Implied volatility-wise, we did see vols hit in equities. So we can see here that we had down, anywhere between 3/4 of a vol and a vol point across most US and European indices. And that's just, you often get that with expiry. You often get people's positions rolling off on the third Friday, and then they have fresh powder to come and sell more options. And so you do get a bit of systematic supply hitting the street, and that can often take volatilities down on that Friday heading into the weekend. We did see Asian vols firmer. You see here in China and Japan. And we saw VIX vol bouncing. It had a pretty bad couple of days, got sold down, probably oversold a bit, had a little bit of a bounce there. So back to sort of 68. Oil vols were up about 4 vols on the week. On the day, not a lot going on. But oil price is starting to break down through quite major support levels, spooking the market a bit there, potentially thinking there could be some more volatility on the horizon in oil. So the vols kind of reacting on the back of that. But in general, commodity vols slightly softer. In terms of the carry side of things, nat gas is your standout at plus 34%. The implied vols are at 110. The realized vols in the 60s. So that does look like quite a good short for those who are brave enough to have a stab at that. Be very careful on your sizing. We do know that natural gas can be a bit of a beast and move more than 10% in a day. But that's why it's priced at 110 volts. So let's be clear. It is priced for movement. So it can you can digest quite a lot of movement being short that stuff. Obviously, last week we did highlight a trade that we had done in our portfolio on nat gas. So that's one we quite like at the moment, actually, especially with Thanksgiving week likely to be fairly quiet. Skew-wise, equity skew drifting back somewhat. It has had a decent bounce, though, so up on the week across most of those indices. Still percentile-wise in the lower percentiles. This cheap skew theme that's persisted for months now is likely to remain into next year, as we don't see major demand for hedging to materialize that hasn't already done so. So even if markets do drip lower, we think in general discretionary managers will be well positioned for that. And it's not going to induce some massive bid for downside that comes out of nowhere into year end. So I wouldn't expect skew to really keep gapping higher like it did over last week. I wouldn't really expect to see that into year end. And also some realized skew analysis that we do in our weekly report shows that, that there's probably a bit of a limit to how far skew can go based on how it's realizing. Okay, what else? This week ahead, if we go have a look at what's going on. So obviously COVID news getting more negative from China. Their first reported deaths in 6 months has got people spooked. Beijing are imposing new restrictions. So this whole hope of China COVID relaxation, zero COVID relaxation is kind of reversing a bit. And we were skeptical that they were just going to go and reopen as well. So it seems like the market is mean reverting some of those trades. Other data points this week are global PMIs are expected to show contraction, especially in Europe. FOMC minutes, probably not going to be market moving. Plus, we've got a couple of central banks, New Zealand and Sweden, expected to hike about 75 basis points, or not about 75 basis points, what they're expected to hike. Other than that, activity is going to get cut short, obviously, by the Thanksgiving holiday on Thursday in the US. And then outside of China reopening optimism, which seems to be driving the reversion in markets, we also had this sort of narrative around light positioning and bearish sentiment being a reason why markets may have bottomed and might rally now. And that itself is also kind of unwinding a little bit. If you look at some of these CTA positioning analysis, You got the CTAs now back to positive equity beta, which is in the 36th percentile. So these guys are not as underweight as they were. A lot of the rally that we've seen in recent times has been these guys getting more, more neutral or even long again. So we don't think there's this big chase coming from CTAs if the market trades higher. Obviously, there's some big hurdles to break on the upside in terms of technical levels as well. So we just continue to think that some of this rally and short squeeze may have already played out. You look at some of these most shorted names, you look at the ARC basket, that's all trading back down again, even though long end yields are staying low and treasuries are bid in the long end. Normally that's good for the ARC names, and they're not really managing to rally. They were down 10% last week. So I think this Santa rally that people might still be playing for may disappoint this year, and we're comfortable leaning slightly bearishly on risk assets still. Okay. Now, if we move on, so as I mentioned, I do think risk assets are still vulnerable. If we look at some of the cross-asset metrics that we look at, I mean, we've got copper, ARC, the 2-year yield, the S&P, and the dollar all on here. So when we had that big rally post CPI, obviously everything flew higher. And now you look at the amount of reversion, right? So you've got copper reverted all the way back to the levels that it was before that move. You've then got the 2-year yields back as well. So they got down to 430 odd, and they're now back to around 450. So they've given most of it back. You've got the ARC ETF giving, at least half of the move back. You've got the red line, which is the dollar. That's back to 108 after hitting around 105.5 type level. So that's reverting. Obviously, it's still got room to go back to get back to 110 where it was. But then look at S&P. S&P's parked up here and has barely reverted off its highs. Okay, so we got to highs just above 4,000, and we're still at around 3950-ish, basically, right? So really, the S&P is the standout here that is lagging the mean reversion we're getting in all those other assets that responded to the weaker CPI. The S&P is kind of not doing the same as those things. It's holding up stubbornly well. So we do think the S&P and US stocks basically are vulnerable to a bit of a catch down to come more in line with what those other risk assets are doing, basically. So that's why we're comfortable leaning a bit short risk assets right now. If we then look at what we saw in metals, we have been saying that metals outperformed in that move on the China reopening and on the CPI, and it was because of short positioning. So we can see shorts getting covered here. So both in gold and in copper, there were short positions that had built up, and they have now flipped to positive. So we got that big short squeeze in gold, copper, and silver on here. Both copper and silver have reverted and are now negative compared to where we are here from the 10th. So 11 days ago. Gold is still up 2% since then, but the point being that if all these guys have covered all their shorts now, this market might then just drip back down again because those shorts, the short squeeze is done, basically, right? So we took advantage of that short squeeze. We hedged out some silver positions that we hold in the long term via some bearish risk reversals. That was in one of our daily notes last week, and is also in our options overlay portfolio. For those of you who subscribe to that, you'll be well aware of the exact trade that we did, the strikes that we picked, and the maturities, etc. But yeah, we took that short squeeze in metals as an opportunity to hedge rather than something we were going to start chasing. Okay, now in terms of what we're seeing trades-wise, so VIX is interesting right now. VIX, which is the volatility of the VIX, has been smashed again. It did have a little bounce on Friday, but in general, it's on its way down and it seems to be leading the way again. So VIX itself was stable at around 24. VVIX made new lows, is down to around 68 in terms of the volatility of the VIX. That's not the VVIX level, but that's the implied volatility of the VIX, the 1 month. So basically, we think that VIX may well continue to be stable. We think it might make sense to start leaning longer, but the cheapness in the VIX vol, what you're seeing is you're seeing buyers of call options, right? So obviously you've got some people hedging tail risk. You're starting to see open interest building in the January to March next year, 60 to 70 strike range. So that's what I've highlighted here. Now, we're not convinced that the shock factor that you need to induce a major VIX spike in the short term, we just don't think that shock factor is there, basically, right? We think the macro isn't that pretty, but the market's well aware of that. And really, to get VIX spikes that go from, where we are now in the mid-20s to 50 plus, you need the market to be surprised. And we don't really see that at the moment. Okay. So what would we do to be long VIX rather than buying these calls, which might look cheap to some? We still think they're relatively expensive because we don't really see the VIX having that spike. We actually think buying puts makes more sense. And if you're bearish on vol, then obviously you just buy puts. And the reason why we're saying that is because normally the implied vol on VIX trades at premium to realized vol. Okay, so this is our VIX dashboard, and we've basically got the vol carry at 0. So normally the vol carry is positive on the VIX because the VIX tends to have some risk premium in it in terms of the vol. That's completely gone away. Our strategy compass is obviously pointing to buying vol here. It's saying buy straddles, strangles, or buy calls. But in general, it's in the buy because you look at the implied vol on the VIX and it's down here at the lows, basically. You look at what the curve's done. The curve has collapsed over the last week and over the last month. So we definitely see the front end of the VIX curve, front end of the vol on the VIX, that is, coming down. Now, skew-wise, you also see skew relatively low. And when skew is low in the VIX, that means that calls are not as expensive as they normally would be. But they are still a good 30 vols above the equivalent puts, right? So 25 delta calls on VIX are 30 vols above 25 delta puts. So for us, we actually think the value in the VIX vol is to buy puts and delta hedge them. So if you are bearish on the vol, then you would just buy puts and you buy them naked. And that's a nice simple trade. And I will catch you all tomorrow. Thanks for listening.